Hey, thank you all for having us. Well, it's never been hotter, attracted more tourists, or been more talked about. And I'm not just talking about Abu Dhabi during Finance Week, I'm talking about private credit. Just like this city, this asset class was considered under the radar not so long ago. We're here to talk about the opportunity set with some true locals of the credit landscape. Francesco from Fasanara, who's been using fintech platforms to reach borrowers that banks often leave behind. Volkan from Vibrant, a deep specialist in CLOs and structured credit. Mihir from Lone Star, representing one of the industry's most storied funds, investing in everything across corporate equity, real estate, credit, and more. And finally, Lindsay from Pollen Street, a specialist in financial services, investing at the cross-section of PE and private credit. Lindsay, I would love to start with you. You sit at this unique intersection, and you're a financial services expert here. The topic really asks us, why might companies choose to raise debt over equity? With PE dry powder at record highs and rates coming down, are we finally going to see the M&A floodgates open? And if so, as a lender, are you willing to trade those lower spreads for higher deal volume, or are you going to hold the line on pricing?
So we're going to hold the line is the punchline answer. So thank you for inviting us here today. Pollen Street, as Carmen says, invests focused on financial and business services, clearly a sector that's going through massive structural change, especially since the global financial crisis. And we've been investing in that sector for 20 years and dedicated to financial services since the financial crisis. You know, whether a borrower chooses equity or credit, there is a place for both. What we're looking to do is by being deep in our sector, we're aiming to deliver top-tier returns in each of our sectors with a very narrow distribution of outcomes. So in private equity, that means 3x gross with no losses if it doesn't go according to plan. And then in credit, we're also, like the previous panelist, in asset-backed credit, we're delivering 12% unlevered from investment grade type risk and zero losses across the platform. So we're effectively, as a specialist in a sector, aiming to cut off the left tail of distribution of returns, but not compromising on the returns themselves. So I think that wherever we go, whether a business is looking, we think the asset-backed, and others kind of are in the sector too, but we think asset-backed is a very important provider of providing finance to the ordinary economy, the everyday living of getting mortgages, getting car financing, SME financing. They empower the everyday economy as opposed to, that's how we would define it, as opposed to transaction and buyout type. So I think that it will continue to be forever thus. There'll be appropriate times for debt and equity. I think for us as a GP, the challenge is to make sure we're delivering alpha, whatever we're doing, and we try to do that in a very narrow risk band as well.
Volkan, your turn. Let's talk relative value in structured credit. We're seeing a resurgence in the syndicated market and some tight spreads in corporate credit. So for an investor sitting on cash today, why would they look at CLO equity or mezz tranches versus just buying the underlying loans? With the default cycles staying surprisingly benign so far in 2025, what do you see getting better or worse as we head into 2026?
Thank you, Carmen. Thanks for the nice introduction as well. I do think 2026-27 will be more volatile than the last 2 years for sure across the credit markets. In broadly syndicated markets, it's been too quiet in terms of defaults actually, but there has been LME, liability management activities where the borrowers try to take advantage of the lenders. In terms of CLO's relative value, if you look long term, CLO equity and mezz tranches have been performing really well over the last 20 years. So I've started investing into this area in 2002. Total CLO issuance was 18 billion, 1/8. There's over 1 trillion outstanding now. Through this growth, through the great financial crisis, etc., these vehicles prove to work. The architecture of CLOs work. And I'd like to remind that through the GFC, the only securitized product that didn't need a bailout is broadly syndicated CLOs. You might remember TALF program, TARP program, mortgages, CMBS, even the banks got bailed out, whereas the CLOs never needed that because of a couple of key features. Your assets are shorter maturity than your liabilities. That's great. It's the opposite of Lehman, right? There's underlying diversity in the pool you invest. It should be invested at least to 25 different industries, otherwise rating agencies will downgrade you. So there are no hidden correlations, it's really diversified. Finally, most important, your structure doesn't depend on the mark-to-market of the underlying assets. So during COVID, for instance, you have seen even investment-grade bonds, for a month, they fell to 80 cents. Loans fell to 70 cents. No single CLO had to liquidate or had a margin call whatsoever, because the structural features, the tests in CLOs are non-mark-to-market tests. So if you're a long-term investor, I think it always provides good risk-adjusted value. What we model, you know, my background is in physics, so what we model when we model CLOs, we started modeling less recovery in broadly syndicated loans. We expect less recoveries, not 70 cents, but maybe 50 cents. Even then, a CLO double B tranche tends to sustain 8 to 10% default every year, the next 7 years. 10% default in this market has only been seen one time in 2009. And 2010, it was less than 2%. So they are resilient. The market is tight, so it's going to get, market will be a bit volatile. But if you're a long-term investor, you want steady income, I strongly recommend CLO mezzanine equity.
Francesco, you have a more interesting strategy. In a world where these spreads on large cap direct lending are compressing below 6% and terms are loosening, your unique universe is kind of fintech and SME credit. So with the Fed and ECB cutting rates, are you seeing more tourism capital flooding in to your niche seeking yield, or does the complexity of specialty lending keep the premium intact? And as you deploy capital today, are you finding better risk-adjusted returns in financing the platforms versus the underlying loans directly?
Thank you, Carmen. Good to be here. Tourism capital coming into our place. Definitely, there is a lot that in recent years and also in the last 12 months has entered the space. So we count a lot more competitors than we used to years ago. Like Fasanara has been around 15 years almost, and at the time we started there was literally very little. Like today there is a lot, so you can count the competitors in more than 40 of them perhaps, that either in dedicated funds or in broader mixes of credit that can look into our asset classes. So there is a lot, definitely. I would say that what puts us into a nice spot is the fact that very often the vast majority of this capital is available for easier, lower-hanging fruits. For example, marketplace consumer finance, and especially in the US, where large volumes are available. And so for some of these large players, it's kind of an easy one to start off when they look at the platforms. And that is a space that indeed has compressed in spread terms quite a bit in recent times, probably by 200, 300, even 400 basis points over base rates, over cash. Where we look is more into more complex situations where there is more of a complexity premium to be grabbed, like for example SME specialty finance. And over there is more of a bridge to cross in terms of knowledge about the collateral pools, and there is more of a also data-rich environment if you want to play that side of the game, and more the ability to construct behavioral ratings, transaction ratings, and so to have the ability to feel comfortable about something which is less low-hanging fruits, and for which spreads are still quite elevated, and I would count them as still quite a lot above the equivalent direct lending in corporate space that is available. So yes, there is a lot of competition, a lot of tourism capital coming to place, but there are still ways to play the game in such and such a way in which you can extrapolate an alpha and utilize your track record and your lengthy experience to deliver good risk-adjusted returns.
Mihir, the consensus seems to be soft landing, defaults are manageable, but Lone Star often looks where others aren't. If corporate credit cycle is improving, as the data suggests, where is the value and where are you finding the opportunity today?
Yeah, thank you, Carmen. For reference for the audience here, so Lone Star Funds is a private equity fund For the last 30 years, we've raised 25 funds, about $100 billion of capital. We currently manage $55 billion, and where we're finding opportunities are on the credit side. We invest in private equity buyouts, commercial real estate, and credit. But in the private equity buyout vertical, we also invest in corporate credit, but it's not direct lending. It's focused on pull-to-par strategies where we see a business which we know very well. We focus on industrials, asset-heavy industries. So if we see a business we know, we start tracking it, we underwrite it through the debt, we start buying the debt because we think the business will restructure. And we've had examples where we've gone into owning debt before the restructuring in the US specifically, where the markets are deep. And then we sit through the restructuring, we reorg the equity, we reorg the debt, we take back some debt, and then we own companies at a very, very attractive valuation. So it's a deep value approach, but it requires a credit underwriting, and then with the view that you'd like to own the equity and control the company, improve the company, do the value creation analysis, and then eventually reposition the company for an exit. So I think credit has evolved. I think the general view of credit is direct lending and it's all very bad, it's all going to blow up. But we've seen a lot of structures, very intelligent structures that have developed in the market where you can actually own very good businesses which are just poorly levered, badly levered, over-levered, but they're good operating businesses that you can turn around. I think that's where we see a lot of opportunity.
So we're in the capital of capital, so here is one for all the allocators in the room. Why allocate to credit now? The past few years, it was a no-brainer. You had equity-like returns of 10 to 12% in senior debt with no volatility, but we're in a very different rate and equity environment now. So does that math still hold? If I'm a CIO, tell me why I wouldn't just rotate back into public equities or good old private equity. Lindsay, please.
Yeah, well, you asked the question, are we compromising on pricing and structure? We're in the asset-backed world of credit as well, and we're not compromising on yield. We're still delivering 12% unlevered on what we assess to be investment-grade risk. And we are doing that on looking to deliver a zero risk, zero loss environment. We also don't compromise on our structures. Most of our deals have about 12 covenants in them and very tightly structured. Goes back to the point that's been consistently made if you have a robust structure. So I think the risk reward is still there. I think there is a development in the marketplace, and people talk about asset-backed finance being new. It's new in the structure of asset management. It's existed, I've been investing in the sector for 30 years, so it's existed for many, many years and decades. A lot of it used to get executed by GMAC pre-financial crisis. So the asset class has existed, and like my panelist said, had performed all the way through the financial crisis, so has very strong track record of performance. You then say, well, why invest in credit? I think a lot has been done in putting the base level of portfolios together with direct lending, which is the first asset class, the anchor asset class. There's still a lot of work to do in maturing those portfolios to do what happened in private equity, where you start with buyouts, which direct lending is the credit equivalent of that. You're then seeing that asset-backed is a really strong diversifier. It's non-correlated. In stress, its duration contracts as opposed to extends. So there's a lot of, and then you're finding real asset credit. So there's a lot to do in the development of portfolios in private credit from the initial stages of drinking from the fire hose of direct lending. So I think there's a lot of maturity to happen in those portfolios.
Yeah, I mean, equity versus credit in this tight environment for credit. Yes, I agree with that. We shouldn't forget, though, that credit, especially senior secured loans, is senior to equities of the companies, right? So at the end of the day, this is the last thing that loses money after equity gets wiped out. So then when you say, like, shall I allocate more into equities than credit? Credit is tight. Are equities cheap? 7, 8 equities are taking S&P 500 to unknown places at this point. So I do think like there should be credit allocation, should approach it long term. This kind of environments that are coming, volatile environments, less recoveries, etc., it will create dispersion among managers. Some will not perform. It's just the fact. Just recently, as you know, the First Brands default was a big news. Tricolor default was a big news. I checked on our data, out of 120 CLO managers, 102 had exposure to First Brands. We had zero exposure to both of them, and there are other managers who had zero exposure to both of them. At the end of the day, equity, credit, all the balance sheet of an enterprise, of a company, are derivatives of the enterprise value of the company. So as long as you do your work, fundamental analysis, how to calculate value, then you can make better educated decision. Do I invest into equity? Do I invest into senior debt or something in the mezzanine? So that's the way I will look at allocation going forward.
To me, it's all about execution, right? There is no strategy that is good in every market environment, but there is a declination of any strategy that can perform relatively better in that market environment. So, if you look at it from a macro standpoint, yes, spreads are very tight. As Volkan said, there is also the price of liquidity. Today, there is a plentiful of liquidity, so it's imaginable that we need to be in a situation like this. Macro-wise, within private credit, there is on the one end, ABF that we are discussing here. On the other end, there is direct lending. I mean, I think there is something to be said about the fact that direct lending and it can also be executed very well, right? Don't take me wrong, but in general, it is true that it tends to be a floating portfolio which is quite concentrated, long in duration, with some leverage, some sub-investment grade connotation to it, and of course, in a moment in time in which the market may go in a down cycle, presents certain vulnerabilities at the aggregate level, right? Then you can still execute it very well. Not only that, but also it grew fantastically well in the last few years. So I think it went to almost $3 trillion in a manner of a few years. So definitely we need to look into that as the cycle goes through. Next to it, asset-based finance is is not EBITDA lending, it's more collateral-based lending. And so you have something to rely on, tends to be also absolute return, less correlated with the level of SOFR. And then there are different ways of declining it in turn, right? So you can decide to focus on certain aspects of it, like in our case, for example, is shorter duration loans of a highly granular nature. Right, so heavily diversified with a short duration, which I think performs better in a weak market environment, relatively speaking.
I think from our perspective, it's everything's about how much risk you're taking, right? So, I'll give you a few stats. The U.S. residential market is $48 trillion. The residential mortgages that are outstanding is about $14 trillion. Every year, there's about $1.8 trillion of mortgages that are written in the US. The market that is non-agency mortgages, which is people who have their own businesses, their own distributions, not salaries, which is non-agency, that market is $80 billion. It's a huge market. Those loans are originated at few basis points higher than regular agency loans. So you're getting opportunities in a market that is $80 billion, growing. It was 60 before, 60 to 80, 80 to 95 is expected this year. And there are a lot of these pockets of opportunities which are very large, which we're finding great amount of value in, because these are asset-backed, they're home mortgages, and they're first lien.
So I'll do one last fire rapid round. I think we've all been loving hearing that this is the golden age of private credit. But if typical direct lending is getting crowded and expensive, where are you investing next? We'll go down the line.
I think we're generally going to see the evolution of the private credit market reflect private equity with different asset classes, whether it be asset-backed, clearly is a theme, secondaries, real assets, reflective of the whole span of the asset class and maturity of portfolios to reflect that.
I think the last 3-4 years, all of you have been hearing private credit, direct lending, etc. Now, you know, it's sort of come to realization that there is a certain amount you can swim. I fear all these monies that is raised could flood into asset-backed lending space. Although asset-based lending has been out for a long time and there are experts sitting here, there might be a lot of tourist investors coming in without the expertise into the asset-backed side. That sort of fears me a little bit. But at the end, my message is like, these are all liabilities, these are all derivatives of value, be it collateral or be it corporate. The investor should have a perspective about the valuation, i.e. the economy in the first place.
And like, if the question is which opportunities we see, like 2026, I would say that we need to be aware, cycle aware, right? That the cycle may turn. It's not for sure, right? Because there are also plenty of indications that liquidity may sustain itself well into next year, right? There are certain indications, especially from the US administration, that may be like a bull year, 2026, in that respect. But let's say that we are also at the end of a very long cycle. It could be otherwise. And so in that sense, I think personally, it's not so much about this sector, this opportunity specifically. It's more about keeping the portfolio as much as possible, short in duration, highly diversified across also countries and sectors, and then with very low levels of leverage, because that turn could take place.
All right, Mahir, wrap us up. One last prediction.
Yeah, I think we're going for using credit for control, right? That strategy and residential mortgages in the US.
All right, may yields stay high and default stay low. Thank you all for joining us, guys.
Thank you very much.